Hi, I'm Greg Heibel. I'm a partner at Orrick, Harrington, and Sutcliffe in the Emerging Companies Group here in Silicon Valley. Term sheets is my life, and if you ask my wife, that's it. That's all I do. But I have the pleasure today to have two fantastic co-panelists who I sat in the middle. I should have let them sit next to each other because the best kind of mock term sheet negotiation is where the panelists actually kind of get at each other's throats. I think, based upon a call we had, a pre-session call, there's the possibility of some violence here. There's some strong feelings. So I will allow Ken Elephant and Farb Nivi to introduce themselves. Ken?
Hi, I'm Ken Elephant. I'm a general partner at Opus Capital. We've been investing in startups for about 35 years. We used to be called Weiss Peck and Greer Venture Partners. We focus on early stage investments, so ideally Series A investments like this term sheet is here. And we invest only in IT, so we don't do clean tech or healthcare. We've done a lot in the internet layer, companies like DoubleClick. We've done a lot in enterprise software, so companies like Versa Systems, and several in the infrastructure space, so companies like Riverbed. And that's the gamut of what we do.
My name is Farb Nivi. I'm the CEO and co-founder of Grocket, which is a online collaborative learning game. Actually, our first beta product out there is a GMAT product, which is a little bit late for any of you folks. But the idea is that anyone preparing for their GMAT comes to our platform and they collaborate live on GMAT questions, and there are game mechanics that incent their behavior, as well as some sort of intelligent algorithms that adapt the system to your performance and help you improve your GMAT test or SAT test, or ultimately just generalized learning. I did a Series A couple years ago and a Series B last year, so that's my experience in managing term sheets. I've learned most of what I know from venturehacks.com if you want to check that out. That's a shameless plug for my brother's blog, but it is true. And it's not just him. Naval Ravikant and a couple other cool folks contribute to it. But I did a lot of learning before I did my first one. I had great advisors when I was negotiating my term sheet in my Series A and in our Series B. And those are, I think, really important pieces that we obviously can't really replicate here in this session, but are part of the larger process of creating a temporary marketplace for your shares.
It's not a replacement for a really good lawyer, ideally from Orrick, but I will second Venture Hacks. It's a great place to, if you're trying to find a primer on what to expect and what the process is going to look like from a real world entrepreneur standpoint. It's a great place to start.
Yeah, I actually had excellent lawyers too that were critical to the process. So yeah, that goes without saying for sure.
But it does help you kind of get into the groove and understand the dynamics of how it will work. Because there will be plenty of times when you're not going to be with your lawyer going through term sheet and negotiating the deal. And so the more familiar you can get with the whole process, the better off you are, and the fewer times that you'll have to sort of use a lifeline and call your lawyer. Ken, it's your term sheet or XYZ's term sheet. You want to start out explaining why this is a good deal for Farb and his company?
And well, Farb, it's been a pleasure getting to know you over the past few months. I'm
Likewise.
Really excited about your company and your idea, and I'm very much looking forward to partnering with you. So what I've put together here is a standard term sheet that we've used at our firm, and I look forward to building the company with you.
Yeah, we're actually really looking forward to working with you guys, and I think with the right match, we've spent some time getting to know our company, and we've done our diligence on your side, and I think it's going to be a real strong partnership. And there are just some pieces of this document that I've looked at with my advisors and counsel, and I'd like to just see if we can see a little bit more eye to eye on some of the pieces. So I guess I can sort of mention some of my non-starters if you want to talk about that, or if there's specific areas.
If you have questions about anything, I can explain everything that's in the term sheet. And what I've tried to do is put together a term sheet that will actually work for you. I mean, I understand that having been in your shoes as an entrepreneur before, building a company is hard, so I'm trying to put together something that works for you.
Yeah, that's great. So a couple of things. I can sort of talk about them in general, then we can address them individually, or we can sort of address them as we go, or try to at least. The valuation is something that is a sticking point for us. We essentially have a convertible debt that we have had on the table for a while with some folks, some angels, and I think we chatted about this before. And so for us, there is another option, and if we can't get the valuation that we're looking for in a Series A, we'll just do the debt round, and we'll work on a Series A sometime next year, or when the time is right. So I guess I don't know if this is a sticking point for you guys, or there can be some discussion around the valuation, because currently it doesn't make sense for us, and for me, acting on behalf of all the shareholders right now. It doesn't make sense to go with this when I have a convertible debt document that I can do that's, about a little bit less than half of the investment, but it'll get us through the next, 12 months and into product launch and things like that. So.
And let me stop for just a second just to clarify what's going on, because Farb's got a competitive deal, and just in case people aren't understanding what his competitive deal is, he's got angels or somebody else who's willing to do convertible debt, so some sort of a note that will convert into equity at a future point at some later Series A financing at usually some discount to, or it's accompanied by warrants, but at the later valuation round. At the later valuation that's set by the Series A round, and so these guys will get into an argument of what that means and whether that's good for Farm and or Ken.
And if you guys are interested in, participating in that debt round, we can do that too. We'd love to have you guys on board that way, and you're obviously lined up pretty nicely for when the Series A occurs. But yeah, like I said, the valuation currently is not competitive with what we already have on the table in terms of convertible debt.
Yeah, so I think that is definitely a viable option. From our perspective, it all depends how you want to build a company. You've done a lot of research on us, and you've called a lot of our entrepreneurs, and I think what they have told you is that we work really hard in terms of opening up doors at customers and partners and helping you recruit the VP level team that you're looking to recruit. And so, given that, what we tried to do is come up with a valuation that's, as fair as we could make it, just based on all of the deals that we're seeing. And we think that the amount of money that's going into the company is a competitive advantage for you, because you're going to be competing with other companies out there that probably only have $500K or so in seed or angel money. And with $2 million in the bank, you really can press on the gas and take the market by storm.
Yeah, that's obviously we want to get a couple $1 million, maybe 2.5 in the door. It's really the pre-issue valuation that is the problem for us. So the investment amount is right. We can get by with the $850K debt round that we're going to do, and we're going to actually leave that note open up to $1.5 million, so we can continue to add to it. But we have about $750 to $850 committed, and so it just makes more sense for us to put that 12 months of runway out, and then we can drive a Series A valuation that we feel confident would be 2, 3, 4 times what this is. So if we can get that done in 12 months and have that sort of impact on our actual Series A, it's kind of something we just have to do. So I guess if this is a non-starter for you guys, we can talk about some other things and see if we can come back to it, or if you want to go back and chat with folks and figure out if how much of a deal breaker this is, that's fine as well.
Yeah, so we discussed this at our partnership meeting last Monday, and the partners all agreed on these terms. So I would need to go back, but just in round terms, what are you thinking about?
So we wanted to actually bring in around 2.5 at about 8.5 post.
Okay.
So a 6 pre.
Right. And how did you come up with that in terms of comparables? Because what we've tried to do here is, since we see about 3,000 deals a year and invest in about 8 companies,
yeah.
What we've tried to do is do what's market. And you've
I guess
built a
I'm
great
just
team.
trying to make this term sheet look like something that I would prefer over the debt round that I have. So that's how I arrived at that number.
Right. Sorry, there's a question.
Sorry, can you explain what you meant by 8.5 and then 6?
Yeah.
Sure. So go ahead.
The question is what did he mean by 8.5 million post or 6 million pre-money? So the valuation that's in the term sheet here is a $3 million pre-money valuation. And when you put $2 million into the company, then the post-money valuation is $5 million. So in this case, the investors would get 40% of the company, or $2 million over $5 million. What Farb just asked for is a pre-money valuation of $6 million and $2.5 million investment. So that would be $8.5 million post. So $2.5 million over the 8.5 is the percentage ownership for us,
29%.
which is 29%.
You hear people talk about 2 on a 3. That's $2 million on a 3 million pre-money valuation. Okay, let me stop since we've stopped. So obviously he's looked for an enormous pop-up in the pre-money valuation. How often and how successful generally are entrepreneurs at asking a VC to go back and get a higher valuation? I mean, is it typically the case that on the valuation it's baked once it's gone through the partners the first time?
Different firms work in different ways. So at Opus, when we put out a term sheet, we're done with all of our work and we're ready to sign the deal. Some other firms put out term sheets and it's kind of the start or maybe the start to beginning of or middle of their process. So for us, this would have never come up because during our process, we would have gone out to dinner probably 3 times and we would have talked about how he wants to build his company, how much money is required, and we would have talked about what's important to him. But given that this is a mock negotiation, I'm trying to act.
Yeah, I'm totally in agreement. You're right. This was not, the laboratory loses the context of reality, which is that most of this is agreed upon before there's an actual piece of paper saying what we spoke about in dinner conversations, emails, phone calls.
Yep. What I can say is Farb is actually working with me because based on the numbers that he threw out there, the venture firm owns 29%, and most venture firms want to own certainly above 20%. For us, we like to own 25% plus because we're doing the Series A rounds. So while going down from 40% ownership down to 29% ownership is a huge step down, I think having 40% is a bit egregious. I'm
sure. I've seen legitimate real term sheets with that, Series A term sheets. So it's, I think it's egregious too, but it exists. And I also agree that, the 25 to 30% area is reasonable
more standard for one VC. If you have 2 VCs in a deal, 40% is more standard.
Right.
Yep. Should we go back?
Yeah.
Yep.
Each VC will take 20. And the reason that's important from the entrepreneur's perspective is if a VC has such little ownership, then the VC won't be as committed to your company. So they'd be much more passive. Whereas what I told him before is that we're going to work our butts off to open up doors. We're going to work really hard to bring in a great management team for him. That's what I was trying to get across there.
Sure.
So you guys want to defer on the valuation since obviously this is going to...
Well, I was going to go one more thing on that.
Okay.
So what I was going to ask you, Farb, is, I think that this ownership is fair. I'd like to go back to my partnership with something that's fair. I appreciate the numbers that you've thrown out so far. I'm not sure how the partnership will react to that.
Sure,
so
I understand.
Can you give me some sort of range that you feel comfortable with that I can go to the partners?
I'd say, 2 is the minimum, 2 to 2.5 is what we're looking to do. If you guys wanted to do over 2.5, that's fine. And then probably no less than 7, 7.5. And if you want me to come in,
post money.
Yeah, post money. And if you want me to come in and chat with folks again, I'm happy to do that, and or make some, have some phone chats too. So I appreciate you taking that back to folks.
By the way, the dynamic that was described about the dinners and it's socializing, that's a very Silicon Valley way of dealing with term sheet provisions. East Coast, foreign investors, it can be very different. And you can have situations where the first thing you know about evaluation is when they throw the term sheet down, and you really do have these sorts of negotiations. Very unusual out here other than a mock.
And it might be an exploding term sheet, which, you can explain in detail, but it's basically like act now or it's gone. And I would advise not dealing with people who give you those sorts of term sheets.
Yeah, I agree with that. And I think that every VC should treat every entrepreneur equally. Obviously, if you've sold 2 companies in the past, you're going to get a more friendly term sheet. But, at least our philosophy is treat the entrepreneurs like we wanted to be treated when we were entrepreneurs.
Yeah, and usually most of them were. That's actually legitimate. I get that feeling from most VCs that they're very entrepreneur friendly. Although this interaction is going to make them seem really sort of nasty, I think they're actually very entrepreneur friendly.
Okay, so why don't we keep going?
Yeah, great.
All right, so I think I heard you loud and clear. I'll go back to my partners with what you said, that you're looking to raise somewhere between $2 and $2.5 million. You could potentially go higher than that, and bottom basement post money valuation is 7 to 7.5.
Great, awesome. Thank you.
Okay.
I guess I also want to chat a bit about the founder agreement. So the couple things I wanted to address is I've been working pretty much full time on this project for a solid year now, without any real income, scraping through my savings, and I'd actually like that to essentially count towards my vesting schedule. And right now you have it such that my founder shares will 4 years starting from the point of issuance, which will be at the first board meeting, which is going to, if we close this, going to be in 2 months from now. So not only did I not get that first year, I'm going to lose the next 2 months as I'm killing myself trying to close this deal. So for me, it would be important to be able to get that year's vesting and actually have the vesting point start at we'll set a date a year ago approximately.
Well, actually, the way that we listed this out here actually works, I think, well for you. So as we discussed, I have a great chief marketing officer that you'd like to bring into the company. And she's, almost ready to join. I think I can help you get her over the finish line.
Cool.
She's very savvy, as will be a lot of the other VP-level folks that you bring into the company. The first thing that she's going to ask is, what's your vesting schedule, Mr. Founder?
Right.
And if it's unequal, that really creates a very strange culture and paradox inside of the company. So
sure.
I actually wanted to put this together so that
I understand, yeah, and I totally appreciate that. And I guess my feedback is a little bit different from folks, around the valley, other entrepreneurs that I've chatted with and VCs, and I haven't heard that as a reason. What I've mostly heard is that people understand that founders often have slightly different arrangements, and I think the logic that I explained to you, I would explain to the marketing director, and I would expect anyone to understand that. And in fact, I would expect that marketing person to get the same thing had they started working with me last year. Whether or not we even called them a founder technically or not, I would totally agree that they should also have that year's vesting. But they're starting, actually, if we bring them on board, they'd be starting now, so it's logical to have 4 years. So I think what the way I'm looking at it makes sense, and I know it's a pretty important point for me. And then the other issue would be some accelerated vesting if I get terminated. Because currently, right now, I would lose. We haven't gotten to the board yet, which is the next thing I'd like to talk about. But currently, if I'm removed from the board, from the position of CEO in the board, I lose all my shares. And actually, if we put those two together, I could be fired in like a month or so, and then literally not have one single share in my company that I've been working on for a year. So this just creates an opportunity that I need to have off the table.
And Ken, Farb and I talked about this before your meeting, and I think Farb would be looking for some amount of single trigger acceleration, where if he's terminated without cause, he'll get some acceleration, and then full acceleration on a double trigger if the company's acquired and then he's terminated. His shares get fully accelerated.
Okay.
Yeah,
So, Farb, I hear you loud and clear. I still think the way that this is worded works best in your favor. I mean, the reason that we're investing in this company is because of you and your involvement.
Right.
If you were not involved in this company, Farb, we would not be interested in working with you.
Yeah, likewise.
And we really need your involvement with the company, and you've committed to that, and so I think that's great. This, really just puts it on paper that when you're at the company, adding value to the company, you're vesting.
Yeah, I mean, I guess I'm just kind of, I agree, I would more strongly agree that that's the way you felt if you removed that opportunity to execute on this agreement from the table. Then I, would be supremely confident that that what you sort of just said is really the sort of type of relationship that you want to create. And, my job is to, work for the shareholders, increase the value of the company. I don't want to be thinking about, my board behaving in egregious ways. And like I said, I just need that. I actually think it helps you guys because if the option is completely removed from the table, you can't be pressured by anyone to act on it because it's not an option. And so we have to just work together as opposed to sort of remove each other. I can't really remove you, but this sort of allows sort of one-way control. And that's sort of what would be an issue for me. I want a sort of, coexisting relationship here where we're sort of incented to work together as opposed to have the opportunity and the door open for what I would think is sort of egregious behavior by either party. And I don't have any opportunity for that, and I think we should sort of create an equal arrangement.
And so what are you recommending?
Oh, I guess in terms of, just 1 year, the year I've spent, so my shares will vest monthly, starting right now, no cliff. They start vesting right now because I've been working and I'm going to continue working, so they start vesting monthly for the next 3 years, 1/36th per month, starting the day of we create the company.
Or functionally, it's the same as what you're asking for, but just giving him credit for the year that he's been working.
Yeah.
It's 4-year vesting, which is totally standard, but give him credit for the time that he's actually been working.
For the first year that I've spent working, and the cliff is like essentially over as well, and then he can give you the details on the type of accelerated vesting.
Okay. So on the vesting side, I hear you loud and clear, but if this company does get into an acquisition mode, obviously the acquiring company is going to want the founding team there. I mean, you're the heart and soul of this company, and that's where a lot of the value comes from.
Yeah.
So
I guess, another issue is that, we've been working together on this deal a lot, and I'm interested in your participation on the board specifically from the firm, and I have to deal with the reality that there's no guarantee that you're always going to be at that firm, and so I don't have a guarantee that you're always going to be the board member. I can think of plenty of examples of great board folks that were VCs at one firm and moved to another firm, and they're not on the boards of the startups that they helped, get off the ground, and that can be real, shock for me as a CEO and for our entire company. So to some extent, I have to create protections around just the possibility of you not being there one day and having some other person who I have no idea what their behavior is going to be like relative to yours to deal with. So again, it's just sort of a protection around taking these opportunities to, play weird games off the table. So that we can just kind of concentrate on working together and always working together.
So I hear you on the vesting schedule. So let me think about that as part of some other things that we're talking about. But let's talk about this acceleration because single trigger acceleration, which is that if he gets fired from the company, that he accelerates his stock. That
6 months worth.
That is very, very difficult for us to do. Because basically that would incent you to potentially just to get 6 months of vesting, do something bad so that we need to fire you.
I guess I don't.
So,
I think that firing me is the worst thing you could do for this company. So I don't think it's doing anything for any of the shares that I have at that point to fire me. That would
So
think
what
that's
I'd
true.
like-
if you think that I would think that way, I wouldn't do business with me, because that's just I think an extreme
Right.
thought that
But
no rational person would engage in.
But that's the reason that single trigger is completely non-standard. And if you look at the NVCA documents, it's not in there. Now, what you're asking
Sure.
for in terms of double trigger acceleration, which means that if the company gets acquired and your position in the new company materially changes, and you have some sort of diminution in terms of your type of role in the new company, then perhaps it makes sense that you should get some acceleration, because that's something that neither you nor I have any control over.
Sure.
That's up to the acquiring company.
Okay,
So
I guess I'm
so
I'm
that-
willing to think about that if that's
That I'm
that's okay.
more comfortable with if it's limited.
Cool.
The single trigger acceleration, I got to tell you,
Okay.
we would have a really hard
So
time.
the 1 year you're cool with, and the no cliff, and
So on the
you're cool with
vesting
double trigger
on the vesting
and not
schedule what I recommend is that you. I think it's great that you worked at the company for a year. I was going to suggest something shorter than a year, so to split the difference. But if you're willing to vest over 4 years after the investment, then I'm willing to give you a year up front.
Yeah, that makes sense.
Okay.
Yep.
So we'll
Great.
do 1 year of credit, and then you'll vest the other 80% of your stock over the next 4 years.
Yep.
Okay.
Ken,
20, 75%.
No. One
so
year.
25% will be vested
No,
as a
20% up front, and then
so you just
20%
described a
each
5-year
year.
vesting.
Right. Exactly. That's what I'm saying.
I see what you're saying.
Well, that's
Okay,
not-
I'm gonna have
that's
to think
not
about.
market.
I'm gonna have to think about that. It's a little bit. It probably won't be a sticking point, but yeah. I don't
What
wanna
you didn't
make
realize
it
is
sound
that Ken sold BMWs in a prior life.
Yeah. You have a question?
What is a cliff?
So a cliff is when you pass a certain point in your vesting
off and
schedule
die.
that all of the stock options that would have vested up to that point become vested. So in this example, the typical for an employee in the Valley is a 4-year vesting schedule with a 1-year cliff, which means after the end of year 1, that employee will get 25% of their stock options. And then the rest of those stock options, the other 75%, vest over the next 3 years on a monthly basis.
I guess it's a 3-person board, which is good. I like the odd number, and then 1 common, 1 preferred, and 1 independent. So there's 2 issues I have. One sort of a non-starter, one I guess I can want to just chat a little bit more around. In the provision, 1 board seat will be elected by the holders of a majority of interest of the common stock and shall be the CEO of the company. I guess that's kind of my issue. What I'd rather do is create an additional seat for a CEO. So, because in this situation, again, it sort of leaves if I'm not the CEO, then I'm not the common seat, and I'm no longer a director or CEO, in the company that I started. So that doesn't really make sense. And I would be still the majority common shareholder. So I would be the majority shareholder of the common stock, but not be able to elect the director of the common stock because I wasn't the CEO. And according to this, the CEO would have to take that seat. So
So what you're proposing is a 3-man board, unless you're not the CEO, in which case it becomes a 4-man board, but you retain your seat.
I'm comfortable sort of chatting about what we do post that, if it becomes a 4-man board, or maybe we want to restructure the board so that it's also still even and bring another independent on, or just we can play with those numbers for sure. But certainly, just want to get past whether or not that's a sort of non-starter for you guys. I wouldn't be comfortable with this as it is. Maybe if it was we could talk about a situation where it's 2 common, 2 preferred, and an independent. We'll have a 5-person board, and if one of those common seats has to be the CEO, I could potentially deal with that. But again, it still doesn't make sense to me. You're sort of taking rights away from shareholders, and really shareholders should have the rights, which are their rights to elect directors of the board. So the majority of the shareholders should vote for those board seats. So really, my preference would be to create a new seat for the CEO. So that's kind of a stickler for me. And then the other
Let's
issue
do this
would be,
far. On the
electing
board,
independent.
we, like you, think that small boards perform a lot better.
Yeah,
So
I
we
agree.
like the fact that there's a 3-person board. What I suggest that we do is that we leave the language here the same for this for the common. Okay, but should you cease to be CEO for some reason or another, let's just say that you decide to go fly airplanes or something like that.
Sure.
Then why don't we at that point in time come to an agreement in terms of how to make this a 5-person board, and we could potentially add you as a board member, and then have the preferred A get another board seat as well. So it would go from 3-person to 5-person.
Yeah, so you're saying let's not bake it in right now and sort of address it if and when it
Well,
becomes
I think we
an
should
issue?
bake
or?
in whatever the structure
Let's put in
is.
the language that it's a 3-person board.
Okay.
That the common shall have 1 board seat, and that shall be the CEO, which
Okay.
is Farb.
And yeah,
which
right.
is Farb.
And if
And then
God
should-
forbid it isn't.
And then should Farb cease to be CEO, then what I recommend is that we increase the board to 5 people.
Oh, I see.
And the common shall be able to vote in that 4th board member, and preferred A will vote in the 5th board member.
Okay, so yeah, it's sort of like what I was proposing as, yeah, I guess my only issue with that is that it still is sort of taking away the rights of the common shareholders to actually vote based on their majority votes, right, and place all common. I mean, I think.
Well, one should certainly be
I mean,
the CEO, because let's just say that, God
Sure.
forbid, you want to go fly airplanes, and we together as a group decide that we want to recruit a CEO. No self-respecting CEO is going to join a company without being on the board.
Sure.
You will get a crappy CEO, I can tell you that
Right.
for sure.
I mean, I guess I would be, more comfortable going to a situation then where let's just, get rid of the independent and, or rather, if that happens, maybe we lose the independent and the CEO takes that, and there's 2 common and 2 preferred and the CEO seat. I guess I just really don't feel comfortable in a situation where a certain class of stock cannot just vote for their
But that
class
is, that's
of
board
that's
seat
what
number 4. Board seat number 4. Is
yeah, so
in the
there's,
case that you will not be a CEO. That's
there's only
exact-
one that we'd get to vote on, right?
Correct.
So
Well, the
there'll
other
be
one's the
one
CEO who is working at
Sure,
the
I
company
guess
and
my,
is a common shareholder.
Yeah, the CEO is technically a common shareholder.
He's blowing smoke on that point.
Yeah, the CEO is a common shareholder, but it's a lot. I think it's pretty likely that they're going to be pretty investor leaning. There's a lot of issues with, obviously we're bringing in a new CEO that it may have to do with an issue of my performance, and this means that you guys are heavily, picking that CEO, and they're just going to naturally be investor leaning. So I guess we just end up creating a board where I'm, one of 4, and don't again really have much influence on the company, and I'm just. I don't think it's to the advantage of the company for that to really be the situation for at least through the Series A, Series B, maybe Series C. At some point, certainly, the company may be served better by not having me as the CEO, or even on the board of directors potentially. But I think that's a long way away. So me being on the board and not being having any ability to do anything is essentially like me not being on the board.
Okay. So we probably shouldn't
Yeah.
do that much more. But do you want to talk about what's common in this situation?
Yeah, I mean, and it's all over the map here in terms of what you wind up compromising with. What Ken suggested is getting towards where it's typical. And a lot of Series A deals, if it's a good Series A deal and it's a founder with a hot hand, then he'll often be able to insist that he gets his seat. He gets one, and a lot of times you'll see 2 common. So if Farb had a co-founder, you'd see both co-founders on the board, and then the Series A seat. So the common still controls the board, and there are a bunch of protective provisions that give some protection to the Series A, but the common controls the board. You tend not to see these issues until you get into the later rounds. Sometimes you will see 4-man boards for Series A companies where you've got 2 founders and 2 preferred. What Ken was proposing was where you've got a 4-man board, but FARB is only one. There's only one common holder. The CEO, a new CEO, almost always will be more tightly affiliated with the investors than the existing founder. If a founder's leaving at that early a stage, things have gone badly wrong, and so the new CEO is going to be an unsympathetic.
The other thing that I'm trying to protect against is not having somebody that's dissident on the board. Because if there's a founder that's just trying to make trouble that's on the board and they vote no when there's some board votes, it can make things really sticky from a legal perspective.
Sure.
Like when you're trying to sell the company and that sort of thing. So the way that I was trying to do it is to have FARB be the number 4 person on the board, but have that be language that in the closing documents would be pretty loose. That would say something to the effect of, we will use our best efforts to do X, Y, and Z. So that if FARB is leaving the company, we will negotiate that as part of his severance package.
Yeah,
that's what I was going for.
What I stopped sort of doing after the first discussion around the valuation was going back to my convertible debt note that I had on the table, which I actually should have on every single point, talk about how I have an alternative. Especially here, because by doing a convertible debt round, there is no board created at all, and I control the company entirely, essentially. Well, depending on what we got the valuation to and stuff. So but at least there's no board, and we can sort of put off that decision to a Series A. So really, I should have just harped on that a little bit more. It's really, I think, the most important thing for a founder going into any negotiation is having a best alternative, right?
Should we go back to the liquidation preference?
Yeah.
I think is
Let me
probably,
just add one last thing. On the board, you'll see that there's an independent board seat here. There needs to be a mechanism in here so that there's a way that person gets nominated and accepted to the board. Because right now, he could nominate someone and I could say no. I could nominate someone, he could say no, and it would be just a 2-person board, and that would be ineffective.
Series A will receive prior and in preference to any payments to the holders of common stock a per share amount equal to 3 times the original purchase price of the Series A. It seems, my preference would, just be 1x, but I'm willing to, I guess, split the difference and say 2x.
And I assume that this is a typo, that it was 3x,
yeah,
and with full participation after the 3x initial.
Yeah, that's what I'm assuming. Sorry,
right.
my internal
No problem.
made a mistake. But this is a participating preferred, which means that if we invest $2 million of our money into the company and the company gets acquired for $10 million, we get $6 million back first, and then we split up the remaining $4 million on a pro rata basis, which is what we described on page 1.
So it's not a typo. You did intend to fully participate in the process.
No, I think he was explaining the typo, or no?
That was your intended deal.
I wanted it as participating preferred because FARB without a cap. Because FARB, as you and I discussed, we have so many companies that we can potentially invest in. We want to invest in companies and entrepreneurs that want to grow a company to a very large rate.
Sure.
And outcome. Because if this company just gets built to, say, be acquired for $5 million, it's not a great use of your time or our time. So
sure.
This is the type of mechanism that I think works well for you because you and I will be motivated in the same way to build a large company here.
Ken, isn't this going to hurt you in the later rounds when the Series B and Series C money come in and say, well, great.
We want this as well.
There's no full participation, no cap. It's one thing if you're doing this at a $3 or $5 or $6 million valuation, but if you start doing the next round at a 25 pre or a 40 pre or higher, and you've got full participation, not only is FARB going to get hammered, but you're going to get hammered. Even if you're taking your pro rata, eventually that will cut back. You sure you want to do this at this early stage?
So what I'm trying to put in place here is something that incents everybody the same. So for the later rounds, we'll solve the later rounds at that later time.
I guess, yeah, I mean,
And,
my understanding is
assuming-
that's almost impossible. Why, I guess put up such an enormous task ahead of us and let's just bake in something that will serve us both now and serve us both
Now,
in the later
given,
rounds. Which
given
we
that you wanted
anticipate.
such a big step up in terms of valuation, what's more important to you, the valuation or the liquidation preference?
I'd have to think about that.
Well, I think we'd be looking for a reasonable market liquidation preference, and this isn't even on the aggressive side of market. This is just completely outside of what you would see in a term sheet here. So even if FARB is looking for something that's on the higher end of market reasonable on valuation, it would be fair to at least see something on the investor-friendly side of market fair.
Okay, so what would you suggest, FARB?
So we were thinking maybe a 2x on the first part, and put
So
some
it's
sort of-
capped.
Basically capped.
So no participation.
So no participation above the 2x,
Correct.
right? But a 1x participation below 2x, correct? So take me through the math again. If the company gets bought for $10 million,
And you guys put in.
just let's say that we put in 2 at 5 post.
So, I mean,
So
So you guys either get 4, or you choose to convert to common, and then you have a total. All of the common are treated equally, and you're just like every other common holder.
Right.
And so there's an economically rational point at which you'll convert to common.
So I get the $2 million back up front because we're putting this money to risk. We should be the first ones to get our money back.
Sure.
So we do get that, and then what you're saying is we participate pro rata after that point, up to the point until we get 2x on our money.
right.
Right? Okay. Yeah. So that I would go for. That's pretty much standard. It's either 2x or 3x.
Yeah, and I would even say it's especially these days. If Ken got $4 million back, he got his money back, and then an additional 2 before any money goes to common. That wouldn't be totally outrageous either.
So the cap that FARB is talking about is at what point would it be better for me to really convert to common and just participate pro rata, which is on page 1?
And here's one of those places where it's helpful to have the lawyers involved, because the arithmetic is actually not arithmetic, it's actually math. And so you want to have somebody who can help you model it out, and it's not obvious and it's nonlinear, particularly when you have participating preferred. If you graph it out, it's got steps through it, and so.
In reality, this rarely comes into play. What happens is a company gets purchased, the management team, or the company's trying to get purchased, the management team says, if it's a downside scenario, listen, we're going to just leave this company and here you can have it, or we want to carve out. And so all these liquidation preferences get renegotiated at that time. So I totally agree with what you were saying, which is why set a precedent that the later round guys can leverage off of. That is really good logic.
And I'm sure Ken doesn't have any companies doing down rounds right now. That's where we're seeing this come up a lot, is when companies are doing down rounds and new money's coming in and trying to deal with the existing preferred holders. Then you start really cranking on the models and spending a lot of time on it. You were really grumpy about the drag along.
Yeah.
So
No
that's,
drag along.
And by the way, we're
so-
skipping over a bunch of stuff, and just in the interest of time. And so
I guess my issue here is that anyone, in the event of any proposed sale event on page 5, drag-along rights, where such transaction is approved by the holders of a majority of Series A preferred and each member of the board of directors, the founders and all 1% stockholders of the company shall be required to vote all capital stock in favor of such transaction. So essentially it's, this is the same one that we had. It's saying anyone that owns less than 1% of the company just does what you guys tell them to do, and it's sort of like, I think people should just be able to vote their shares, and wherever the numbers sit, they sit. There's going to be a lot of serious stakeholders in the company that are going to own less than 1% of it, like a lot of the founding team. We're essentially removing any influence they have on anything. They're shareholders, which already doesn't make sense. They built the company. It doubly doesn't make sense. So let's just strike this
The
paragraph.
issue is that when companies get acquired, if there's dissenting shareholders, there can be all sorts of lawsuits and things like that. So Farb, you're a big owner in the company. You have 30%
Sure.
ownership in the company. Why would you want to have some other shareholders that aren't nearly as involved as what you and I are control our destiny and potentially get the company into a bunch of liquidation, and a bunch of litigation, rather?
Yeah,
I think it's a lot better to make sure that everyone's aligned, and that's exactly what the board is for. And that's why we negotiated the way we did on the board. And I think you're happy with how you're being represented on the board, and I'm okay with it. We own 40% of the company, and we only have one board seat. So, I mean, I think that we've been as fair as we can. But
So, Ken, if what you're trying to do is protect both yourself and Farb from the smaller investors, you're assuming that Farb is going to be on the board and is going to approve the deal. Why don't we change this so that if it's approved by the holders of majority of the Series A, each member of the board, and the founders?
how about a majority of the board? I mean, I think that's better because
Well, but if Farb only holds one seat, then if the concern is not Farb, I mean, tell us if the concern is that Farb isn't going to approve a deal, then we'll deal with that one way. But if as you said, the concern is that other investors might dissent, and you're not worried about Farb because you guys are completely aligned, then let's make sure that the drag-along can't be triggered without Farb's consent.
Yeah, I think it's more that I think that everybody should be under this drag along. That everybody, when the company is sold, that everybody's voted in the same direction. That'll make for an expeditious process. Now, the reason that we're investing in this company again is because of you, Farb. But let's just say that you want to go fly airplanes like we were talking about before. Mm-hmm. Everybody's going to be working at this company, and the company will have decided that it should get sold. And if you are back there throwing eggs just to be difficult, that I think is a very unproductive process.
I guess
for
I
the
just
company.
can't imagine this situation where I'm about to get cashed out of this company that I have all these shares in, that I even put in less work because now I'm flying planes and for some reason I'm going to make trouble and not just get cashed out.
Aren't you really concerned about a deal where Common gets nothing, and he objects to having the company sold out from under him, and he gets nothing for it, and that's why you're trying to put the provision in place so that he has to vote in favor of that deal?
Yeah. So.
I mean, if we
So
can just, like you said, include not have founders as the third point here, right? And not include founders in the drag along portion. The 1%ers, I think I can deal with.
I think it's
So the
reasonable
issue,
to have the
I think-
founders dragged if the founders approve.
Yes, that's my point. Yeah, absolutely.
Yeah. So,
Drag with
from my perspective, for this company to get acquired, it's going to be because of the founders. And there's no way that a company can get acquired without, the founder and the rest of the team moving forward. So as long as, you're committed to working with us in good cases and bad to get the company sold at the right time and at the right price, I'm okay with that.
Okay, great. And I mean, all my negotiating is around again incenting us to sort of have to work together when we come up to situations that don't have easy answers. So I'm totally.
So we'll go through the exact language here in the closing documents,
Cool.
but I understand what you're trying to get to.
Good.
Now this is a major sticking point, and I would say that in like 75% of the term sheets, there's drag along that's put in there, and it's for good reason, unfortunately. So
I mean, my experience, most startups have more than one founder, and I would say 95% of, and I'm kind of making up these numbers, but in broad strokes, they're right. 95% of startups, one of the founders is gone in a year, and so what you worry about is not Farb, who's going to be there through the acquisition because he really believes in the company. He's a good guy, and he's a company man. You worry about the founder who's gone.
So that's exactly what I was talking about when I was talking about going to the closing documents. The closing documents will talk about who a founder is and how a founder is defined. And so I would make sure that it would be a fully employed person of the company. So anybody that's not employed by the company, can't throw turds at the company later.
Yeah, and I mean,
And that's
Like
what
you
we
said, in a lot of situations, you have multiple founders. Obviously, the more founders you have to start with, the more likely you are to lose one of them as time goes. And I think they would all agree that it would, that provision makes sense. That you have to be employed at the company and the founder to sort of be a part of that. I don't think there'd be much division around.
Now, all this being said, Ken, have you ever actually seen this implemented, where you had to pull the trigger on the drag? Or is it all? In my experience, it's always sort of the sword of Damocles, that it's out there and nobody
Exactly.
Nobody will actually require somebody to trigger it. There's some question as to whether it's totally enforceable,
Right.
Legally, and that's off the record.
Depending on the state that you're in, right?
Yeah, depending upon the circumstances.
I agree, but it is very important that when you do get into a sale process, that no one can hold it up. So, for example, if a founder had left the company, he may want some hush money to vote yes. That's something that we would never allow, right?
Yeah.
But I have seen cases where
Really?
that happens.
Okay. That's interesting.
So you want,
Thanks for the
from an
idea.
investor, from an investor's perspective, you want everybody doing what's in the best interest of the shareholders, and that's why drag is there.
Yeah.
And we're towards the end of the time, so we'll take some questions. There was one other point that I just wanted to highlight because we didn't talk about it, and it relates to the valuation, and it's the size of the option pool.
Oh yes. That's another hour.
It is because it's a backdoor pricing negotiation because you bake the size of the option pool into the pre-money capitalization of the company. So if you have a big option pool, then you wind up with a smaller price per share for a given valuation, and so it's a way of backdoor negotiating over price.
From my perspective, it would be great if the entire option pool came out of the post.
That never happens, though.
Right, that's what I'm saying. That's my extreme. His extreme is the entire thing coming out of. So to the degree that you can move closer to what you would ideally want, get away with what you can, do what you can.
The standard is what's here. What's egregious is the percentage. Okay, so 20% is high if we have a CEO at the company and we're not planning to do a CEO search. And so if you and I were negotiating on this, I'm sure what you would say is, listen, all we need is a VP sales, so that's 2%, VP marketing, that's 2%, and a director of engineering, that's 1%. So all we need is 5%.
Yeah, he actually gave the best, I think. That's the best line of reasoning is you actually went and did some comps and figured out what the exact percentage is for all the people you need to hire, and it's that number. And then you have a reason for why it's that number, and it may be 5, 6, 7, 8, 10%.
Now, what's standard is that there's some slush on that,
Sure.
like at least 4 or 5%, because you want to bring in advisors. You want this option pool to last well into the Series B, which should be at least 24 months, just in case something goes wrong and you need to extend the Series A. You might get a bluebird person that could come in as a COO and demand 7%, and the last thing that you want a company to do is pass on really good people because they don't have the shares in the option pool. I mean,
But
obviously,
what I would tell the company is it's a bluebird, and if it's a bluebird that is not in the plan that was baked among the founders and the investors before the financing, then everybody ought to share in that dilution. That shouldn't come on the back of the founders.
You can always create more shares. There's nothing stopping. It's just one board action away from magically having all the more shares you want.
it's true. But I'd say that the average option pool in most Series A term sheets that are this early stage is 15%.
Yeah, I'd say so.
Thank you.